Welcome everybody to our 2026 Outlook podcast, where I'm once again joined by the team to take you through both the macroeconomic and the market view of the world in the coming year. Now, as always, this is a two-part podcast. The first one is going to be about the economic outlook, and then the second podcast, which you please do tune into, is been looking specifically at the financial markets and what they could have in store for all of us. So I'm going to start off with turning to Charlotte on the global outlook. Charlotte, we had remarkable policy initiatives coming out of the United States. We had tariffs the highest for about 100 years. So there was a lot going on. Surely 2026 is going to be a smooth run relative to 2025.
Yeah, let's hope it's going to be slightly less exciting than the last year was. When we look forward, we see growth holding up, trend-like, which is pretty good in an economy that's really facing quite strong headwinds from the tariffs. Compared to the past, what is really kind of emerging as a new growth driver, at least looking backwards over the past decade or so, is investment. And that is really helping to support growth globally, and it's an encouraging sign. It's a year when we don't actually see much downside on the inflation side. Inflation has already come down, moving sideways, maybe edging a bit lower in some regions. And it's also a year when we, in contrast to last year, we don't see those kind of large rate cuts that we saw last year. A bit more policy easing to come, but not really the key driver of growth. So for 2026, I would really watch investment. I think that would be the key driver of resilience in the global economy.
I mean, I was going to say, it almost sounds a bit dull. Trend-like growth globally, inflation coming down a little bit, interest rates at the margin coming down as well. What is your biggest worry for 2026?
It's probably inflation. There's a lot of spending on, we know all about it, on tech, on AI. There are supply constraints in that field. And inflation is still a little bit too high for central banks to be really comfortable. So we're very clear what the base case is. Inflation should be contained, so we don't expect a reacceleration in inflation. And I think that's good enough, actually, for 2026. And of course, my key worry, my key risk is probably to watch inflation if we see any kind of reacceleration there.
And any upside risks that you could say, well, actually, I mean, you mentioned technology. I mean, some of the numbers that we've seen bandied around in 2025 have been mind-boggling. Are we going to get more of the same in 2026? And what does that mean from a growth dynamic, a global growth dynamic?
Yeah, definitely. I think it's investment, and in combination with fiscal spending, that could really create a stronger growth environment where you could even see growth rising above trend. That's not the base case. There are still constraints in the economy. Interest rates are still high. The consumer sector is still quite weak. So I think it's really the investment side. I would expect to see more of that. Importantly, I mean, the whole AI sector, it has grown at a very, very rapid pace. And I think now the size of that sector is it's still small, but it's becoming big enough to make a difference at a national and even global level.
Now, you mentioned that maybe interest rates don't come down very much more, although that's still probably the direction of travel. But what about the fiscal side? Because I know you've been touching on this in the past and saying actually 26 could be the year where certainly in the first half there is a fiscal impulse. And could that change the outlook for the year?
I think that's already well known. It's quite clear. We know about the US, we know about Europe. So I think the fiscal piece is inside that number. Yeah.
Okay, so that's not a bad starting point. Let me turn to you, Puneet, because she also mentioned that the growth dynamic is going to be trend-like. When we look at what's happened so far in 2025, financial markets have been up, interest rates have been coming down. What does that mean for financial conditions more broadly, and how do you see that affecting the global growth dynamic in the coming year?
I think financial conditions are easing, and actually we complain about credit spreads being extremely tight from an investor perspective, but what it does to the global economy is it actually provides a lot of fuel. It's not only tight credit spreads, but it's also the abundance of credit availability to large issuers. I mean, take Meta as an example. It wanted to place a $30 billion deal. It got 125 billion of orders. On a day where its stock was down 14%. So I think it is actually shows you the abundance that we have in the credit markets. And that is really good because banks are still not that easy in terms of their lending criteria and lending standards. So it does provide fuel if there is investments coming from AI spending or M&A, which we are seeing pick up as well. the financial conditions with tight credit spreads, abundance of credit availability is actually fueling global growth.
Are you worried that it's almost too loose, some of these standards? Is this a potential problem for some of the credit that's being issued? Are standards a bit too lax potentially?
I think by and large, I would still be comfortable with the issues which are coming. So, for example, like Meta, I mean that's a big issue with a very strong balance sheet and large operating cash flows. But over time, there is the risk that as more and more debt comes to the market, which is basically supporting the AI investment, you could have risks emerging, and particularly in complex structures where the transparency is less, or where you have data center backed debt, which is not as diversified as one of the large tech behemoths.
But from your side, financial conditions getting easier, that's supportive of the global growth dynamic.
Yes, absolutely.
Very good. Now let's turn to you, Tom, because of course the United States is the biggest economy in the world. It's the one that's been in the headlines the most in the last 12 months. How do you see this developing? We had a Trump administration who was very keen to get things done prior to the midterms that are coming up. But kind of what's your base case for the US economy in the coming year?
Look, first of all, we have to definitely acknowledge that the US economy has been much more resilient in the face of the highest tariffs in more than a century. And I would expect that trend to continue well into 2026. Some key topics that we will observe or that will drive growth are clearly substantial fiscal stimulus, continuation of robust consumer spending thanks to still very healthy household balance sheets, then a continuation of AI, CapEx spending, and finally Fed easing monetary policy further on.
So when we think about the tech dynamic, we've heard from Charlotte and Puneet about that's being a primary, if not the driver of growth coming through into 2026. How do you see that? Is it too concentrated? Are we too dependent on this kind of tech investment to push growth?
Look, we definitely have to make a difference between what is driving markets and what's driving the economy. As Charlotte already mentioned, AI CapEx spending is quite substantial. It's big, but it's still relatively modest if you look at it relative to the US economy. What is still more important, I would argue, for the US economy is still a continuation of consumer spending, because that is the single biggest growth driver in the US. But of course, we also need some support from business investment, and there within investment, it will be AI and AI-related investment in semiconductors, data center, energy grids, everything connected to that. So that definitely is also needed to see a continuation of robust growth in the US.
Now, I mentioned the midterm elections coming up in 2026. How significant will that be for domestic policy? Will that change the narrative of the current administration? Will they back off, or will they be pushing as hard as ever to get changes happening?
Well, first of all, they probably will try to push through as much change before, the midterm election, or at least before the new parliament then is taking place in early 2027. It probably won't change as much as you might think. With first of all, it will depend on whether it's the whole Congress switching or whether it's only the House or the Senate. Currently, forecasts tend to tell us that it probably will be the House of Representatives that will switch, but not necessarily the Senate. So that means that Trump probably has less of support in Congress, but he can still try to rule via executive orders. That's to a large degree what he has done already. So that probably wouldn't change too much. And also, if the Republicans keep the Senate, that also means that the nomination process won't be changed. So all in all, it probably won't change too much. And also, maybe looking at the market, it wasn't actually a bad environment for financial markets to have split government.
For sure, yeah. Now, you mentioned about the consumer. It's still the biggest part of the US economy, as you mentioned. Now, you read a lot nowadays about the K-shaped economy, which I understand is that there's a large part of the society in the United States, the wealthier part, that are doing very well, thank you very much, and continue to do so. And then there's the other side, where there seems to be more struggling going on. When you look at some of the corporate results, it seems that there's a large part of the US that is still finding the current macro environment challenging. Any change in that, and could that be a disruptor for 2026?
It clearly will have an impact on the political outcome of the election, quite clearly, because when I mentioned robust consumption and healthy household balance sheet, that clearly refers to the upper half or upper third of households, because they benefit from higher house prices, they benefit more from higher stock markets, while it's clearly the case that lower income households, they suffered. They even suffered before the tariffs, but now the tariffs, which do add quite a little bit of price pressure to everyday shopping, clearly have further undermined the purchasing power of lower income households. And actually, that's also something that we increasingly see this in polls, even in sentiment indicators. There is, I wouldn't call it an affordability crisis, but clearly people are aware that they're worse off to some degree, and that mainly affects lower income households.
Very good. And then maybe finally, Charlotte mentioned about the fairly optimistic view around inflation. You speak about trend growth in the United States in the coming year. I read a lot about the Fed going to cut rates more. Inflation is still well above their target. Growth is still trend-like. Why do they need to cut rates more? And are you expecting rate cuts in 26?
Well, first of all, yes, we do expect further rate cuts in 2026. I think it's more for risk management purpose. And quite honestly, also, we do see weakness in the labor market. That clearly has been the case over the past few months and probably will continue in 2026, while inflation is expected to fade further. However, you're right, and I think Charlotte also mentioned that one of the crucial risks, particularly also for the US, is a potential reacceleration in inflation rates. And crucially, that's not driven by tariffs, because we can already see that tariffs, of course, have an impact on inflation, but the main driver recently of stubbornly elevated inflation have been service prices. While it's not our base case, that is clearly a risk for 2026, and that could undermine the case for further monetary easing by the Fed.
So almost if you see a better growth dynamic, the risk is that could postpone, delay, even cancel further rate cuts by the Fed. We have to wait and see, and of course we will have a new Fed chair by the time that we get into our mid-year outlook. Now I want to turn to you, Ross, because thinking back to our last mid-year outlook last summer, it seemed that prospects for Europe were finally beginning to realize and improve. We had the 1 trillion euros of commitment coming through. Germany was getting it. There was going to be all sorts of spending coming through. I get the feeling from your recent commentary and work that that's faded somewhat. Is that true? How do you see it?
I think that it's unfortunately a correct assessment. Now, don't get me wrong on the kind of over-egging of negativity here. I think there still are some fundamental positives, exactly what you just said, related primarily to Germany's historic commitment to spending likely over 1 trillion euros. So we have that coming through, that will be coming through, and that will be coming through quite quickly next year. There are some concerns at the margin now, as you said, kind of the comments there about this, the nature and the constitution of that spending, composition of that spending, which is gearing slightly more towards tax cuts, some subsidies rather than the big infrastructure spending that we'd really like to see. But from a growth perspective, certainly when we're just forecasting for next year, it's going to be positive. The other thing as well is European growth has actually held up to a reasonable degree. Forecasts for next year are actually quite similar to this year, and this year was actually relatively okay as well. We've had strong performance from other areas. Spain has been a notable outperformer, whereas France and Italy perhaps less so as well. Unemployment still extremely low in Europe, I might add, although it is ticking up. But I think your assessment is correct that at the margin, the data has been a little bit more disappointing on the forward-looking story, even around Germany.
And in terms of that forward-looking story and around Germany, we're already seeing some change in how this trillion euros is going to be spent. Is that a concern? Because on the one hand, it looked like it was going to be on infrastructure, it was going to be in many things that actually had a multiplier effect on the real economy. We know about the defense side. Now it looks like it's more kind of slipping towards consumption, which is maybe not such high quality use of funds. How would you see that?
Yes, I think that's exactly right. So basically, the fundamental changes were essentially twofold. There was the ability the creation of a 500 billion euro infrastructure special vehicle and the exemption of defence spending in excess of 1% of GDP. And we know now they have a 3.5% of GDP target for the NATO target for defence spending, all of which, particularly the infrastructure, was going to be very, very positive. and is still positive. The problem is that the ambition of this government appears to be now slightly geared less towards additional infrastructure spending and just using this vehicle to fund almost kind of pre-planned, already existing infrastructure funds, which of course is positive, but it means that really the fiscal leeway that Germany's given itself is exactly as you say, put more towards things like VAT cuts on restaurants, some increase in pension spending, some subsidies to the energy grid, and things like some subsidies to commuting costs as well. Obviously, all these things are iteratively positive, but the big question, and I think the big concern is that they are just less likely to have a kind of permanent fiscal multiplier that you think the infrastructure will be associated
Now,
with.
we always tend to focus on Germany as the biggest economy, is a very influential one. But we've seen, certainly in the last 12, 18, 24 months, that Spain, Greece, Portugal, Italy to some extent as well, are doing very much better. Is that going to continue? Is this a structural shift we're seeing in these economies, or is this just a cyclical blip?
So I think there is going to be a continuation of this convergence next year. So I think growth in Spain is going to slow down somewhat, but be still consistently a lot higher than the rest of the Eurozone is overall. Even numbers like for Greece and Portugal, they are better overall as well. Italy is a little bit more complex because even though their labour market has been quite good, the actual growth numbers initially have still been slightly disappointing as well. But the point is this: you've seen unemployment come down in what we call the periphery, particularly the large markets, Italy and Spain. You've seen it rise slightly in Germany and France and even countries like the Netherlands. One thing about this is, yes, there is relation to the structural reforms that have happened before, undoubtedly, but these economies have also been massively supported by the COVID recovery funds, Next Generation
And that's
EU.
going to run out.
Well, it will still continue at least for next year. So we'll be talking about it in the annual outlook next year. Maybe be slightly more concerned on that front. But
Now, what's very notable is you mentioned the F word there very quickly, France. I mean, France has been in the spotlight, sadly, for not the right reasons this time. We've seen, obviously, spreads moving up. I'm sure you'll be speaking about that in our podcast on the financial markets. But how do you see France right now? How worried are you about the developments on the political side? And what are the implications for the economy in that basis?
So the French political situation, I think, is the most clear known unknown, the known risk within Europe right now. We can clearly see this unstable equilibrium that exists in the political front. It is, by the time we're recording this, we are still having debates in the French Parliament about the budget for next year. It's possible it gets passed, but we've just seen an enormous vote against the first bill. There's a lot of complexity going on here, and this is all at the same time as France is running a considerable deficit in excess of 5% of GDP and has rising debt still. I think, unfortunately, the risks are skewed towards this situation still continuing to get worse and impact the economy further. We're seeing tax rises coming through, spending cuts coming through as well. It's weighing on confidence in the economy from a consumer perspective, but also from a corporate perspective more generally. And you're seeing it come through in the sentiment as well. And look, for next year, we think it's clearly going to impact negatively. So our forecasts for France are more downbeat than for the rest of the large Eurozone area.
Thank you, Ross. Speaking about downbeat, and I don't mean you personally, China. China, to me, is a kind of perennial disappointment. And I mean that in a way that it has so much potential. We spoke last year, we spoke at the mid-year about them appearing to tackle structural issues with a kind of a cyclical remedy in terms of giving stimulus that's quite short and quite focused. Tell me about China. I mean, their growth rate, they may well get to the around 5% that they were targeting this year. It's the year of the horse, I believe, next year. I don't know if that has any significance in the growth rate, but what does growth look like in China in the year of the horse in 2026?
Yeah, so probably you mentioned that. I think we expect a slowdown in China further in 2026. But before that, we really dive into the headline growth number. I want to take a step back. So there's a lot of debate around China. People thinking about whether China is in depression or China will leading the new world. So the useful way for me to think about China as an economy is that China is being run with two engines at the same time. And the engine that you talk about really is the old engines. We know that, the property sector, and the key issues of that is all other sectors within the economy is very, very highly linked to this property sector. We're talking about local government balance sheet, we talk about household wealth, we're talking about banking system. So definitely as we stand right now, the house prices in China are still falling, and that's definitely not a healthy environment for growth in China to
But why
pick up.
haven't they put a line under that? Why haven't they, put a ring fence and said, look, it's a fundamental issue that we've got housing. This has to stop.
Yeah, I think you got it there because basically they are tackling the structural issues with some of the cyclical measures, and that is a key issue. And so far, it's not that they have done nothing. Since September 2024, they rolled out quite a big package to try to put a floor on the housing market. The problem is it's not enough because it's managed to stabilize a price of the first quarter of 2025, but now pricing falling again, just simply because there are way too many unsold homes in China. I think the package that rolled out probably cover 1/3 of the unsold inventory. And how can you put a floor on a market that's still flooded with unsold inventory? Yeah.
Now, China looked the US in the eye when it came to tariffs. They realized they had a symbiotic relationship. They were too intertwined, interdependencies, to have 140% tariffs. China seems to have done quite well despite the tariffs coming through because, of course, tariffs are still in place. It is a headwind. How do you see that evolving?
I think, so just take a step back, 2025, why China still can manage to get 5% or around 5% target growth because exports were exceptionally strong, especially in the context of tariff, 145% you mentioned, and eventually now it's down to 30%, simply because China have such a strong position in the whole global supply chains. We're not talking about, say, consumer goods like mobile phones being exported to the US, but we're talking about intermediate goods, everything that's fit into the final product, a lot of that coming from China. And we saw that during the COVID disruption when China closed down, the whole world suffer from this supply disruption. So simply, I think China know its strength, and putting a tariff from the, and US have learned that the hard way, that they can cause major disruption within their economy and also global supply chain just by, racking up to 145%. That is definitely not sustainable. Yeah.
Now, you mentioned the two engines. The second engine is around the tech side, I guess. I mean, this focus on really trying to become independent, being cutting edge, lead to breakthroughs in there. How confident are you that in 26 we're going to see a major breakthrough coming from China? And how does that impact their position in the global stage, do you think?
I think it's hard to forecast a breakthrough, but we know that there's not going on in China at the moment. For example, I just pulled out the chart showing that half of the industrial robots are installed in China, half the world industrial robots. So you can see that the speed of change in China is very rapid. And when we talk about technology, we focus a lot about AI, but in China, it's a whole complex from advanced manufacturing, from materials. We talk about battery technology, for example. We talk about materials like, rare earths, we all know that. So definitely, I don't know when is the next breakthrough. Can be 26, 27, 2030, but definitely the speed of change is amazing. And China, with the hope that this second engine, which will be able to replace the first engine that kind of breaking down at the moment. So we are still in that process because, of course, it's very hard to fly with a baggage on your back, and the baggage is the old engine. Yeah. And of course, it's also fit into the whole geopolitical rivalry with the US. It's just fit very nicely because China not seeing technology as the growth driver, but also seeing it as a way to strengthen its position in the geopolitical landscape globally.
So one word, the risk to your outlook for China, higher or lower?
I think it's balanced.
That was nearly one word. Balance. Good pragmatic answer. Now, while I've got you on the hot spot, Japan. Now, I remember when everybody was going to become Japanese. Inflation was falling, growth was falling, demographics were getting older in many parts of the world. Now Japan has become like the rest of the world. We've got higher inflation, we've got nominal growth that's picking up. What's going on? We've even got a new prime minister there. How do you see Japan? Is this going to be revolutionary for Japan in terms of the policy, the Abenomics once again, or how do you see that?
So Japan is a very interesting story. Of course, as you mentioned, it's an uninspiring story for so long. We have deflation, we have shrinking population, all of that. But suddenly, Japan received something very interesting during COVID when they imported inflation. And inflation first appeared like something transitory, but eventually, after 4 years now, inflation above the target, we start to see it change the behavior of corporates, it change the behavior of consumers. So finally, consumers start to spend even though they're under pressures of inflation. But definitely thinking about price will go to the roof next year, for example, right price is up to like at 1.90% year on year. Of course, they start to spend, and that is a quite healthy dynamics for growth to go forward. Of course, Japan continue to face the fundamental issues of demographics. I'm talking about the new Prime Minister. She stepped into basically in the political landscape at the time when Japan been through quite a bit of instability in terms of political with different prime minister and so on. And she brought back this Abenomics style. Of course, now we have inflation. We don't have deflation during the Abenomics. I think if she balanced it well without basically intervening too much into a BOJ operation or basically create the problem in the bond markets. And for the first time, I see that Japan have that urge to invest in AI, invest in defense spending and things like that, and especially with the economy that's seeing shrinking population, that needs to be done. And I'm quite hopeful from that point of view.
Very good. Now listen, I'm going to come back and grill you on the bond market move in our next podcast, which is coming up very shortly for our viewing audience here. So stay with us for that. But I want to turn to the other part of the world. We've got Gustavo with us. Thank you, Gustavo, for joining in person from Chile. I can't believe you left the spring for the gloom of a November day here in Zurich, but hopefully the skies will brighten. Are the skies brightening in Latin America? There's so much going on the political front, whether it be in Argentina, coming up, of course, in Chile itself. How do you see the region? How do you see that outlook for this coming year?
On that perspective, I think this is a positive outlook for the region. As you mentioned, the elections we have recently, midterm elections in Argentina, quite a volatile backdrop going to the elections, but in the end, the result was quite positive for the markets, for the government, and increased the governability going into the second half of Milei's mandate. It was a key driver there, and the markets were expecting this reassurance from the population to carry out the pending reforms that still needs Argentina, and that is a good place to begin this second part of the government. And then moving to Chile, even though the presidential election, still we don't have the result, we are going to the second runoff in December. All probabilities pointed out that the right-wing shift will be seen in Chile. That could be a huge achievement going if you take into account that Chile has faced a lot of volatility that was not typical for a country that used to be sole stability. So going forward, the expectation is that regain that stability that was so characterized for the country like Chile.
We've got a situation in Brazil where not imminent, but we've also got elections coming up there. Interested in how you see the situation with Lula. But I also want to ask you about Brazil because we've often in our work spoken about Brazil for their focus on the inflation, the central bank bringing inflation down from very high levels. We saw, of course, that pick back up again. They've been pretty brutal in terms of cranking interest rates up massively over that period. Will we get rate cuts now progressively starting early on in the coming year?
Definitely, that is our base case. That's what we've seen. Really, we are coming from a really high level of inflation, but given this really cautious and hawkish central bank, that surprised the market, that the market wasn't expected that disciplined central bank. That proved to be correct in terms of inflation expectations, have been coming out quite dramatically. So going forward, I think there is room for the central bank to begin rate cuts after these record high levels. Potentially in the first Q, we can see the first rate cut for the central bank in Brazil. Now,
I mentioned the politics because we spoke about other countries where the tariffs from the US have been reduced significantly, 15% kind of by and large. Now, Brazil has still got 50%, and it seems a lot of that to do with politics. Do you see any sign of that changing? And if not, how problematic is that really for the Brazilian economy with very high interest rates and extremely high tariff rates?
Yeah, well, on that front, eventually when the first tariffs war that came out in the Liberation Date, the region was quite immune for that, but then it escalated the conflict between Brazil and the US. Of course, right now it's a country that's facing the highest tariffs within that, but given that Brazil is not that dependent on exports, and in particular to the US, was contained, and gradually it seems that there has been progress in terms of negotiation between President Lula and President Trump. So going forward on that front, we can see an improvement for next year.
Very good. Maybe to conclude, Charlotte, just rounding off with you, we've heard from our colleagues from around the world, in-depth analysis, and I encourage all our viewers and listeners to look at the full report. As always, it goes into considerable detail. It's a reference document that you can delve into to get the team's views and your favourite region, your favourite topic. But Charlotte, how would you kind of conclude? How do you sum up the prospects kind of in a few words for 2026?
Well, I think I come back to what I said before. It's listening to everyone here. The message is quite positive, maybe with a few exceptions. But I think it is a positive backdrop, and despite these tariffs, because let's not forget about these tariffs are a headwind for the global economy, and it's a headwind for productivity. They are in many ways inefficient for the global economy. But we have that investment piece, we have technology, we have China helping to push those developments, and of course, US trying to also retain its position. So I think it's a positive, upbeat story. But there are risks, clearly. One of them is around inflation.
Great. So thank you all for listening and watching. I don't want to tempt fate here, but it sounds like it's still a reasonable upbeat outlook we've got for 2026. Again, trend-like growth largely across the world, it seems. We've got inflation still in a decent shape. Some central bank cuts coming through. Easier financial conditions we've spoken about as well. So please do reach out to us with any questions you've got for anything around that. Please also do listen to our next podcast. Remember to look, like, subscribe, and look at the document on our homepage as well. We'll be back with you again very soon.